Hi guys. Today's topic is about global financial system. There are two learning objectives in this topic, and I hope that by the end of this topic, you should be able to explain the role played by the World Bank in the international monetary system, and second, explain the functions of the foreign exchange market. So, what is the World Bank? The World Bank Group is one of the world's largest sources for funding and knowledge for developing countries. It consists of five organizations which share a commitment to reducing poverty, increasing shared prosperity, and promoting sustainable development. These five organizations are: first, the International Bank for Reconstruction and Development; second, the International Development Association; third, the International Finance Corporation; fourth, the Multilateral Investment Guarantee Agency; and the last one, the International Center for Settlement of Investment Dispute. Its first goal is to end extreme poverty. It wants no more than 3% of people to live on $1.9 a day or less by 2030. Its second goal is to promote shared prosperity. It wants to improve the income of the bottom 40% of the population in each country. Since 1947, the World Bank has funded more than 12,000 projects. The World Banks provide low-interest loan, interest-free credit and grants. It focuses on improving education, health and infrastructure. It also uses funds to modernize a country's financial sector, agriculture, and natural resources management. The bank's stated purpose is to bridge the economic divide between poor and rich countries. It does this by turning rich country resources into poor country growth. It has a long-term vision to achieve sustainable poverty reduction. Now, we will discuss about foreign exchange market. Unlike domestic transaction, international transaction involve the currency of two or more nations. To exchange one currency for another in international transaction, companies rely on a mechanism called the foreign exchange market, a market in which currency are bought and sold and their prices are determined. Financial institutions can convert currencies using an exchange rate. That is the rate at which one currency is exchanged for another. Rates depend on the size of the transaction, the trader conducting it, general economic condition, and sometimes government mandate. The foreign exchange market is not really a source of corporate finance. Rather, it facilitates corporate financial activities and international transactions. Investors use the foreign exchange market for four main reasons as shown in this slide. First, currency conversion; second, currency arbitrage; third, currency speculate; and the last one, currency hedging. Currency conversions means that company use the foreign exchange market to convert one currency into another. Suppose a Malaysian company sells a large number of computers to a customer in France. The French customer wants to pay for the computers in euros, the European Union currency, whereas the Malaysian companies wants to be paid in its own Malaysian ringgit. So, how do the two parties resolve this dilemma? They turn to banks that will exchange the currencies for them. Companies also must convert to local currency when they undertake foreign direct investment. Later, when a firm's international subsidiary earns a profit and the company wants to return some of it to the home country, it must convert the local money back to the home currency. Currency arbitrage is the instantaneous purchase and sale of a currency in different markets for a profit. Suppose a currency traded in New York. Notice that the value of the European Union euro is lower in Tokyo than it is in New York. The trader can buy euros in Tokyo and sell them in New York and thus earn a profit on the differences. High-tech communication and trading system allow the entire transaction to happen within seconds. But note that the trade is not worth making if the differences between the value of the euro in Tokyo and the value of the euro in New York is not greater than the cost of conducting the transaction. Currency arbitrage is a common activity among experienced traders of foreign exchange. Very large investors and companies in the arbitrage business. Firms whose business are generated primarily by another activity, such as retailing and manufacturing, take part in currency arbitrage only if they have very large sums of cash on hand. Currency speculation is the purchase or sale of a currency with the expectation that its value will change and generate a profit. The shift in value might be expected to occur suddenly or over a longer period. The foreign exchange trader may bet that a currency price will go either up or down in the future. Suppose a trader in London believes that the value of the Japanese yen will increase over the next 3 months. She buys yen with pounds at today's current price, intending to sell them in 90 days. If the price of yen rises in that time, she earns a profit. If it falls, she takes a loss. Speculation is much riskier than arbitrage because the value or price of currencies is quite volatile and is affected by many factors. Similar to arbitrage, currency speculation is commonly the realm of foreign exchange specialists rather than the manager of firms engaged in other endeavors. The practice of insuring against potential losses that result from adverse changes in exchange rates is called currency hedging. International companies commonly use hedging for one of two purposes. First, to lessen the risk associated with international transfer of funds, and second, to protect themselves in credit transactions in which there is a time lag between billing and receipt of payment. Suppose a South Korean automaker has a subsidiary in Britain. The parent company in Korea knows that in 30 days, say on 1st of April, its British subsidiary will be sending it a payment in British pound. Because the parent company is concerned about the value of that payment in South Korea won a month in the future, it wants to insure against the possibility that the pound value will fall over that period, meaning, of course, that it will receive less money. Therefore, a month before it receives payment, that is, on 1st of March, the parent company contracts with a financial institution, such as a bank, to exchange the payment in 1 month at an agreed upon exchange rate specified on 1st of March. In this way, as of 1st of March, the Korean company knows exactly how many won the payment will be worth on the 1st of April. So, these are the four functions of foreign market in international transaction. So, that's all for now. Thank you and see you in the next topic. Bye.